Hello and welcome to Building the Premier Accounting Firm. I'm your host, Roger Knecht, and this is an episode to help you actually work on building your business, focusing on the things that matter: marketing, selling, pricing, client onboarding, and most importantly, retaining the clients that you deserve, all with the intent of getting you paid what you're worth. As we work on this show, we're hoping to bring on the experts each and every week to give you the insights that you need to, in fact, be that premier leader in your business. And today's going to be no exception. I've been looking forward to this conversation. This is Darryl Bates-Brownsword. Darryl happens to be an accomplished business consultant and coach with a dynamic and driven approach backed by over 25 years of valuable experience. He is passionate about empowering business owners to get the most out of their life's work and exit on their own terms. He's known for his ability to connect with others, think strategically, build strong teams, and solve complex problems. Darryl has a talent for the simplifying of problems and guiding business owners towards success. His track record includes building 2 international multi-million-dollar businesses and also working in over 16 countries. Darryl's quick thinking and analytical skills enable him to swiftly identify core issues and understand the broader context. He's originally from Australia. Currently, he is living in the UK. And outside of work, Darryl enjoys cycling, running to clear his head and maintain a healthy life balance. And with regards to all of this, we're welcoming Darryl to the show. Good to have you here, Darryl.
Hey, thanks for having me, Roger. And that sounds far more impressive than I think the reality is, but I'll take it any day.
I've had people say when I've done their bios, that sounds like a pretty interesting person. I wish it were them.
Well, we're all, we do what we have to, don't we? And then we read it and ourselves and, I cringe.
Well, don't cringe. I think what you've done is amazing, and we're going to kind of dive into it today. So let me kind of start with this. The accounting world, the accounting profession, what got you into it? How did you get into this business context?
Yeah, look, in one sense, I sort of fell into working with accountants because maybe because it's my background is I'm an engineer. And the engineer of me is, we're pretty logical and systematic thinking and structured and organized, and there's a similarity there. And I did my MBA because I wanted to get out of the engineering corporate space and get involved in consulting. And the natural focus I did when I studied my MBA is I specialized. I did the most effort in the marketing and the finance side because I just didn't have any of that background in the engineering, and naturally was comfortable with numbers and the finance and the logical side of finance and was naturally drawn to that. And it was the first time because all my studies I was with other engineers and everyone was comfortable with numbers and working with engineers and comfortable with numbers. And when I was doing my MBA, it was the first time I was really exposed to the fact that I guess half the population are really uncomfortable with numbers and struggled with it. So working with accountants felt like I was working with a similar species, so to speak.
Yeah. Now, I know that in the bio, I described you as a business coach and a consultant. So this is going to be really exciting because many of the accounting professionals I work with do get into the CFO advisory space, offering consultative advisory, coaching type services. And so I was just kind of curious, do you have a definition or a way of distinguishing between what a mentor is, a consultant is, what an advisor is, what a coach is? Does that matter to you? Do you bring that up at all?
It doesn't matter to me. And I started in this world in 99 in the coaching side of things. And that's when business coaching was at its real early stages. I was still in Australia at the time and it was pretty early of the market there. And a lot of people got pretty, I guess, pedantic around what a coach was. And, they'd say that when you're coaching someone, you don't give the client any answers. Your role is to ask questions and let them come up with their own answers. And you go, okay, fair enough. And a consultant would bring answers to you and point you in the right direction. And some people would say, well, the sort of work that you guys are doing, it's not really coaching. And we'd go, whatever. It's partly coaching and it's partly consulting because when you're working with clients, they go, look, really appreciate when you draw the answers out of me and you tap into the depths of what I really want and really value that. But on this topic, just help me out. Like I don't want to go through that. Just help me out. You know what the answer is. You clearly know how to direct me on this one. Help me out on this one. And so, always offered a blend or a hybrid between coaching and consulting. And, so we'd bring new ideas to the client and go, okay, so here's the new idea, the strategy. Now let's work together in a coaching style to apply the idea or that methodology or whatever it is to your business, so we get the best of both worlds. Mentoring is, in my mind, is someone who's walked that path before. If you've got a mentor in an accounting practice, it's someone who's probably someone who's exited their accounting practice, was a partner or founder of an accounting practice and has done it all before, and basically says, here's what I'd do in that situation. And a counselor, I guess, is also looking back and just doesn't provide much in the way of answers, but helps you dig in and understand what's going on.
Excellent. I'm loving this little insight as to each of these, because I think so many people have their own opinions of what those are. And really, as we're out there marketing our services, I think the clarity we can bring to what it is we're actually doing for our clients is helpful. So that brings me to a question about your services and the interactions you've had with business owners. As accounting professionals offering CFO and advisory services, there is this question as to what brings a business owner to the point that they're willing to pay for such services. What have you found as you've worked as a business coach and a business consultant that causes a business owner to recognize, I need to actually pay for something here. I need to work with someone else. What's that tipping point that you have found that causes them to do that?
I think I'm going to quote Tony Robbins here and say, I think it was Tony Robbins who said, people won't change until the pain of change becomes less than the pain of staying the same.
Very good.
And I think another reflection I've had over the years is business owners, they'll go through as they're going through their business journey, they'll start off, and it's much like the journey of growing up as a teenage male. And in those mid-teenage years, I remember, as a teenager male, no one's really going to tell you anything. You got to figure it all out for yourself. And that's what it's like in those early years of the business. You've had some success, you're top of the world, you know what's going on. You don't need advice from anyone because you've got all the success and growth and everything's going to plan. Then a few years later, the business stalls, or you've grown to a size or a scale that it's getting out of the scope of your current level of expertise. And I liken that to you hit your early 20s and you look back and you look at your father and you go, well, maybe the old man wasn't such an idiot after all. He had some good advice, and that's when you rebuild that relationship, and your relationship with your parents sort of takes a different dynamic, and from into more of a friendship and respect, and hopefully this is what happens in most cases anyway. And that's the journey I had, and it's we reach a stage where we just go, it's not a failure to ask for help. It's actually, I'm going to do things faster and make less mistakes, and it'll be easier by bringing help in. So it's a tipping point, and they'll reach a stage, and that's kind of a level of business maturity they get to when they reach that point.
Yeah, I love your explanation. I can really relate to it with all the clients that I've worked with. I think there's a good deal of moxie that comes when you're starting the business. There's a good deal of work and effort that's put into the business, and I think it's just inevitable. A lot of companies just start and build simply because of that passion that they bring to the table early on, and they're willing to work through a lot of the mistakes that they're making along the way, and they just kind of push through it. But there comes a point after you've been in business a little bit and you've hired your employees, you start to grow into various things, dealing with cash flow issues, that you start to recognize this is a little bit more than what I expected. And the business owner starts to realize, there's got to be a smarter way of doing this. There's got to be somebody else that's figured out how to deal with the cash flow, the creditors, the vendors and so forth. All of a sudden they're looking for and they're open to these different insights and perspectives, and they're willing to pay for it. And that's the beauty of it all. So I really liked how you were describing it with your explanation. So one of the things I know you focus on and are really good at is obviously the exit strategy and beginning with the end in mind, just realizing what's all this for. So let's talk about exit planning. What really is that? How do you bring that up with a business owner?
Yeah, what is that? And that's a question we deal with regularly, because if you talk to business owners across the spectrum, and I found this in many countries, you can talk to them, and you've got the whole Michael Gerber E-Myth thing where he said, look, you need to work on your business and not in it.
Yeah.
If you say that to business owners, most of them will give you a knowing nod and they'll understand that. They go, yeah, I need to work on my business. I get that. I understand it. And we can argue whether they're doing it or not, but they understand the concept. And then we say to them, hey, look, business owner, Mr. Mrs. Business Owner, you know that if you want to get the most from your life's work, you've been building this business up over 5, 10, 20, 30 years, however long it's been. And business owners often become attached to their business. They think of their business as their pension. They often think that one day maybe they'll exit their business and it'll fund for life after work. And that vision, that concept for them will vary depending on how big and how much they've scaled the business so far and how much they've extracted out of it so far. But they've all got this plan, this concept that they're going to exit their business one day. Now, the way we raise it with them is we go, well, look, if you want to exit on your terms, you're only going to sell one business. And that's the market we deal with most is those people who will only sell one business. And who they're going to sell it to is normally a business that's bigger than them. So, and there's a good chance that the person buying the business from them has bought more than one business before. And so they know what they're doing, and they potentially, if they've done it a number of times before and the business owner is this is their first and only business they're going to sell, they're lacking in experience, and there's a risk that they'll get pushed around and they won't really get to exit on their terms. So it's so important that this is your one and only chance. You've had a fantastic career building and developing your business where you're selling your product. Now your business is the product. What's your sales skills at selling your business? Because you only get to do this once.
Yeah.
So and from the buyer's perspective, they just want to minimize their risk. They most of the time they want to do a good deal. They want to figure out a deal that's fair to both. But hey, look, we're all human, and they'll take advantage if they can and get a slightly better deal. So our job is to go, let's make sure that the business owner is prepared, their business is prepared, and they'll get the most from their life's work. We want them to exit on their terms and figure out what that means, exit on their terms. And then, we want them to maximize their value as well so that, it feels like a fair deal and they've managed to do it all properly. Now, if we can start having those conversations with them 2 or 3 or, the sooner before they want to exit, the better is my thinking. So we've got to create that importance because they all go, yeah, that sounds important. But we also need to create that urgency with the client because, so many times without any proper planning, they think, hey, look, I've reached the point where I've had enough. I just want to get out of my business. I want to sell it now. They'll take it to an M&A, an investment banker or a broker or something and say, look, get me out of here.
Yeah.
That knee-jerk reaction, they just won't get all of those, the most from their life's work. So we've got to raise it early.
Yeah, the first thing that I really liked about what you shared there were the cliches. I think there are a lot of business cliches, and really a lot of the business owners, they hear them, they're familiar with them. Yeah, I get it. Work harder, work smarter, work on in. I mean, there's all these phrases, but they all have meat. And if you just stop for a moment and just kind of dive into what they're really trying to represent, the business owner has a chance to really, I think, work on their business and do a lot of things to really improve what's happening within the organization. But the second thing I wanted to point out is going beyond the cliche. It's the fact that I think a lot of business owners have this epiphany at some point while they're running their companies that really what they've been doing is working at a job. They get up and they go do something and they make good money at it, but eventually they're going to see it as an asset and they need to actually start building that asset. And it's not so much the job anymore. It's I've got something here that is self-sustaining. How do I make it exist outside of me? And the example I usually share when I'm doing this is that of a home. You can live in a house, whether you're renting or owning, you can live in a house and really enjoy it and everything's working fine. But when my spouse comes to me and says she wants to remodel the kitchen, I'm like, why? I mean, the countertops are fine, the cabinets are fine, the faucet works wonderfully well. Why am I going to go through all this money and expense and time to renovate my kitchen? Well, by renovating it, it makes it more modern, and it's an investment in the property I own so that when I actually do the renovation, it maintains the value of the house. It's not because that nothing was functional before, the drawers still worked. It's the fact that I needed to modernize it and keep the valuation of my business that much better when I actually implement, hire people and so forth. So I think that that mindset changes for the business owner when they all of a sudden realize I'm building something here that is self-sustaining, and if I invest in it, it's going to give me a dividend. The other thing that I wanted to do is you were talking about maximizing value and removing risk for the purchaser particularly. So what
Mhm.
sorts of things actually maximize the value of a company?
Well, that's a good question. So there's all sorts of things, and I was reading something just recently by um, Andrew Sherman, I think it was, but it doesn't matter who. But he's saying he did some stats into business valuations over the last 30, 40 years. And in the 1970s, he was looking at the analysis of business valuations, privately held businesses. And I think it was like something like 13% of business valuation in the 1970s was attributed to intangible assets. And that means that, 70 or 80% of the business was, through balance sheet type items and tangible assets that are on the balance sheet in the 70s. Today, that number is more like 85%. So 85% of business valuations today are attributable to intangible assets. Now, what are intangible assets? Because we can't see them on the balance sheet, and these are all the things that make up that nebulous goodwill. And without any conscious thought, we don't know how to value them. So what do? We go, well, let's understand all the things that we can do to maximize valuation. First thing are the buyer's going to be looking at the financial metrics, and they're going to be having a look at your all of your financials, your financial record keeping. They're going to look at your growth rate. The faster growth rate is going to give you a bigger valuation. The less the business is dependent on the owners, so if the owners can step out of the business, that's a big kicker to the valuation. Then we start looking at things like, does everything happen consistent, repeatably, reliably? Now,
Mm-hmm.
part of that is without the business owner there, but when the business owner is there, is it still things are still happening systemized? Are they working to the systems, or are they making up processes every time they start a new one? Are they repeating the old? Are they making it up from scratch again? So is
Yeah.
it systemized? Then we'll start having a look and go, hey, look, what about the routes to market? How does the business get its routes to market? Does it have a marketing machine that can, measurably determine future, work and revenue coming in the future? So if future revenue is predictable because we've got a marketing machine and we know the cost per client acquisition through each of those channels, then that's going to help boost the valuation. Then we start having a look at going, do we have some sort of proprietary product? Now, this is a really interesting one in service-based businesses, and it's a reflection of that intangible asset piece that I referred to earlier. A lot of service-based businesses are just selling hours. They're selling time, the units of time, and they've figured out how to commoditize time and sell the hour. Now, that's a race to nowhere because hours are limited. If we've got a service-based business where we're charging for our knowledge and expertise, and we've been able to demonstrate some expertise and position our proposition to the client so that they're buying our proposition rather than our time,
Uh-huh.
then we're in a position to go, hey, look, we've got people selling the proposition, therefore I can train everyone in that proposition and they can deliver that IP. And therefore, I don't need to get such highly skilled people because I can get less skilled people and train them in my IP, my way of doing things. And then when people leave the business, they may take a bit of a network with them, but they're not taking my product with them. And if I've managed to position my business so that people are coming to my business for my product, then I'm less concerned about people leaving the business, staff leaving the business. So
Mm-hmm.
that creates a nice value kicker to the business because I'm thinking of my business as an asset, and I've got my own product and my own routes to market. They're automated, they're repeatable. Now, if I've got a product proposition, then I've got a brand. Then I'll start to create a brand, and people will start to know my brand. And I'll look at things about people start being attracted to my brand. And I'm talking next level brand, not a nice little logo that we've built and people know that recognize the logo, but they associate the logo with my name. So there's some of the things that we want to work through and have a look at and go, these are the things that can actually boost the valuation of the business, apart from all the ones that we commonly know of about, increasing profit and getting best practice product margin and what have you.
So I'm loving this because a lot of what you're sharing, I think, resonates with the accounting professional simply because of the fact that a lot of this can be quantified. And
Yeah.
as we're going about it, we obviously as accounting professionals might first draw ourselves to the EBITDA and use that number to actually go to the business owner and say, here's the valuation of your business. And that's just one of many ways to determine what the value of a company may be. And what you're doing is you're showing what some of the risks are, or the various areas of the business that can bring value to the business and help with that multiple that the company may get. So as you're talking about these various risks, I'm curious, which ones do you find are the easiest, or the needle that when moved creates the biggest value increase? Are there any that you particularly like to work on?
Oh, there's some I like to work on, yeah, but there's some that get different value increases, and they're
Yeah.
they're easy to do. Um, so if the way I crudely sort of frame it up is, if you think of a business valuation is roughly it's a number associated with profit, and then we multiply that number based on risk to future revenue forecasts.
Mm-hmm.
So what a lot of advisors do out there in the marketplace, they do all of the things that tidy up the profit, because I guess that's tangible, that's realistic, it's easy to do. We can best practice the profit and cut margins, cut costs and fine tune margins, and we can tidy up the financial statements of the business and improve the profit. Now, that's a really important thing to do, but a savvy buyer will see where you've cut costs or you've delayed expenses and maintenance and things like that, and they'll factor that into a valuation. But we still need to tidy up our finances and make sure that all of the costs that are part of the business with the current ownership, if they're not going to be there with the future ownership, then we clean those out of the accounts and we normalize the accounts and present those. And so tidying up the profit, they're all the things that any acquirer would expect to see when they come to do their due diligence. And my take on this is, once you tidy up the profit, you've got to do it, but it's once you've tidied it up and implemented all of those basic practices that you need to keep that profit improved, it's done. And once you've done it, it's done. Now, that'll improve the valuation because by definition, profit times the multiplier will improve the valuation, but it just marginally improves it. Once I've done all that, I'm now working on a solid foundation. I've got a business that's well run. It's got good profit margins. It's typically got good practices and systems, and it's a well-oiled machine. The staff have got all their contracts in place. All of the things that an acquirer would expect to see in place, that they're not going to reduce the multiplier. So we're building a foundation for the business just to make sure you are attractive to be acquired and you're going to be an easy purchase. Now, once I've done all those basic things, then I start working on the more advanced things that we were talking about earlier. And that is, the advanced things are things like, how do we transition the business from selling time to selling a product or a proposition? Do we need to build some product architecture in there, to help with this process? And that's one of the things I love working on, building that product architecture to transition the business from selling time to selling solutions.
Very good, very good. So here's what I took from that, and I'm hoping I'm summarizing this well, is First of all, we want to look at the numbers which are related to top line revenue and bottom line profit. And so if we're looking at those numbers, we want to show that they're consistent and hopefully improving. And then the second thing that we want to do is we want to look at culture, which are employees. Do you have stable employees, people that are loyal to the company, that when selling the business are going to stay there so that they can actually retain the continuity of what's going on in the business? And then the third would be operating procedures. Do you have processes, systems that regardless of whomever it is, we know that we can actually continue to generate the revenue, continue to provide the product or service, continue to have that profit margin because we've got a system in place that's proven itself to be productive. And so if we've got those three elements really fine-tuned, we're removing a lot of the risk that the business owner might have and a prospective buyer may see, so that the multiple can actually go up. Is that a pretty good summation of everything you've shared?
That's a perfect summary. You get those three things, the revenue, the people, and the process all cleaned up. you make the business attractive to be acquired. You make it an easy purchase.
I love it. Love it. So here's the one thing I want to ask. Do you use any tools to accomplish this? Is there something that you're leaning on as you're trying to go through this process with the client?
Yeah, look, we do. We've got to follow our own process, right? So we've got our own tools and we've got our own IP. And, frankly, using that IP, I've been using that in the back of my head through this conversation, because some of it's like a checklist.
Yeah.
And some of it is it's just a process. So we've learned and fine-tuned over the number of years that we've got, there is 21 things that we look at to get a business exit ready, and we prepare a business for exit. And we work with those 21 things. The business has been going for more than 10 years now, and we fine-tune, and we've got that process. What we found is that a number of business exit planners saw that process and they said, look, can we get access to that process in our marketplace? And so what we did was we said, well, we don't want to expand our consulting business to that market. But what we'll do is we've built a digital product. And the digital product it's developed to a stage now that we're pretty pleased with it, if I'm honest. It's called Capitalize. And it's a work in progress management system or a project management system that guides an advisor through the 21 steps process of preparing and consulting and coaching a business owner to prepare their business for exit. It shows for each of those 21 steps, we start off with a valuation through a buyer's lens. So not just what I think my house is worth or my business is worth, but we'll start off with that business valuation. And then we look at the value potential as part of that first step. So we've got a starting value and we've got a value that we think the business could achieve by implementing the 21 steps. And we see the value potential there. And every time we implement one of those steps in the business, it gives us instant feedback of what impact that's made to the client's business valuation. Clients love that because as an advisor, we no longer have to say, hey, look, if we do this, your business valuation will go up on us. It'll be really worthwhile. Trust me, this is what's going to happen in the future. We can demonstrate through a reputable valuation system that, hey, look, we've just over the last 6 months, here's the impact on your business valuation. If you were to sell your business today, here's the valuation you'd be likely to get. And because everything is in order, your house is in order, you will be able to market that business. It's already attractive, and you could possibly even get a higher than average multiple and a higher than this valuation. So the tool is called Capitalize. We use it ourselves, and it's now available for others in the marketplace to use as well.
I love it. Anything that we can use as a tool to help simplify, automate the process, it does make what we're delivering to our clients a lot more repeatable. And it's something that we can then have that's, a standard deliverable that we're taking to each and every one of our clients. So I like this. Here's where I'd want to go next. As accounting owners, accounting firms, we're in a position where we're trying to provide quality services. Many of the things we do are on the compliance side. We've got the bookkeeping, accounting services, the tax planning, the preparation. We move into that CFO advisory space. What I wanted to ask is how, with advisory especially, how do you feel the exit planning really is something that an accounting firm should consider as part of the suite of services that they provide, part of the toolkit that they're bringing to their clients? Why are accounting professionals great candidates to be in this space of helping business owners work on their business?
Yeah, look, I think for me I think accountants have already got a great starting point. And I know the profession has had a lot of pressure on it over the years saying, hey, look, you need to get into advisory. You need to get into advisory. You need to do this. You need to do that. And a lot of that advisory that is, I guess, pushed onto practices doesn't recognize the existing skill set of accountants. Accountants are great with numbers. They're great at preparing accounts and understanding tax and they've got their skill set. And the way accountants work is that they're typically not already consultants or coaches, but some of them, and what this product does, it already plays to their strengths. It's a 21-step process. It's fairly methodical. We've got tools behind each one of the steps that an accountant will pick up and adapt to really easily because it plays to their strengths. And the beauty of this process that we use is that we just recognize that, hey, our primary role, yes, we do a bit of consulting ourselves, but is as project managers. We're like the ringmaster, and we go, hey, Mr. Client, hey, one of the things we need to address is we need to understand that you've got all the legals in place. Have you got contracts with your clients? Have you got terms and conditions? Have you got shareholder agreements in place? Here's all the things we need from a legal perspective. What, you haven't got those? Great. Okay, so do you have a lawyer that you're going to use, that you regularly use to tidy this up? No? Okay, well, if you don't, then would you like us to make an introduction? We know someone that we're comfortable working with, and we work with them regularly so they know what we're looking for to get your business exit ready. So an accountant already has these relationships, and so it's just playing to their strengths to be that project manager. And we've got a project, a start and a beginning and an end of this project of getting the business exit ready, and we just take them through the steps. We show them the starting value. We've got to get a lot of their financials in order, so there's a lot of additional work for let's call it the traditional products of the accounting practice as we take our clients through this. And because it is a structured project, we can charge, or the accountants can charge the client a premium fee for getting their business exit ready, specifically because it's something that the client wants now, as opposed to when they're just doing the compliance work. The clients don't really want that, don't value it. It keeps them out of jail, but it's a commodity product. Now they can really see, and after each step, the value add that getting exit ready provides to their business, and the client's just standing on their existing relationship and network and capitalizing on that, no pun intended. And and they're starting to get the value and deliver the value that they always had the potential of, in my mind.
Yeah. Well, I liked how you mentioned in that process these key individuals that the business owner really should be working with. Ultimately, they do need to be working with that business lawyer, that accounting professionals, that financial planner.
Yeah.
These are people that need to be involved with that business owner to help them really build an asset that they can later sell and really get compensated well for what they've created. So I think those connections, those are definitely the people that need to be involved. The question I want to kind of go to now is this. We've been talking a lot about exit planning. Obviously, as an accounting professional, we can see how we have a role in that and really can go deeper with our clients if we chose to in offering more related services in the advisory space. But the question that I really want to get into is how the business owner oftentimes just doesn't realize how soon this is going to come. And what I mean by that is, in my experience, I've dealt with business owners that the exit planning, it just seems like it's so far off in the future for them. They think it's something that will come some future day. But in reality, life happens. And I find situations where the business does need to be sold or transitioned because of health-related issues. I've seen it because of divorces where the business needs to be changed. There's untimely deaths that have just unfortunately just happened. And here this company is that doesn't have an exit plan. There isn't a clear understanding of what's going to happen next. And all of a sudden, the business is at risk because the steward that was running this, just like you would being a steward of a guardian of a child, it's wayward and it just doesn't have that leadership that's needed because nobody put the thought into how this is going to transition. The timeliness of it is what I'm really talking about. How would you speak to the fact that sometimes business owners put this way too far in the future, and in reality, it's going to come sooner than they think?
Yeah, it's that urgency piece I was talking about earlier. And some business owners go, look, I'm never going to exit my business. And I go, well, you are. I'm sorry, you are. And so we've got to, exit planning and getting the business exit ready has got to be for that unplanned exit as well as the planned exit.
Yeah.
And we need to, one of the things that we like to do is unbundle, by default, we tend to bundle the three beneficial areas of business ownership into one, and we like to unbundle them. And the three areas that I'm thinking of are, the first area of ownership is the fact that I own the business, and I get equity growth and I get dividends by owning the business. Yeah, I'm responsible for funding the business, but yeah, I get capital growth, dividends, and by owning the business. The second area is I get control. And control is exercised, if we look at this functionally, the control is exercised through the board structure. And in an owner-led business, the control is also the strategic side of the business, and gets the vision of the owners, and derives a strategy around that and says, here's a strategy how we can work. And so, there's the control piece. And the third area of beneficial ownership is, hey, well, I have a job in my business as well as those other two areas. And when I work in a job in the business, I get paid an income. So I have a role there. And if I treat that role just like any other employee role, then I can have a succession strategy for it. I can replace myself and have systemized approach and a job description and what have you. And what we found is when we're doing the exit planning is that different owners, especially if there's multiple shareholders in a business, have different priorities and different desires around each of those three areas.
Yeah.
So, some just want a job and go, hey, let me remove all the responsibility and I just want a job and cruise for the next few years. Others have the exact opposite and go, look, I don't want to work in the business anymore, but I want to add value and I want to contribute, so I can do that through the board. And I'll keep my shares and what have you. So the sooner we start thinking about planned and unplanned exits and what the options are for different exit strategies, it puts business owners on the front foot. And the benefit of being on the front foot is A, it gives you a lot of comfort and peace of mind, but B, you end up with a much higher profitable business that's more fun to run as well, because you've typically restructured your career and you've moved out of that career boredom and you've got a new lease of life because the business is so much better and enjoyable to run and it's more profitable. So that's why I encourage people to start thinking about it earlier rather than just going, look, it's worn me down. I'm stressed. I just need to get out of here. A distressed business is, well, it's harder to sell, and you'll never get a good price for it. You'll never maximize value when you're selling it because you feel you have to. If you're on the front foot, you're in control of that as well.
Yeah, I go back to my house analogy. Your house is worth a lot more when it's nice, modern, and cleaned up. It's how you stage the home. But that house that's falling apart needs a new roof. The deck in the back is falling off the side of the house. The concrete's cracked. All of a sudden, it's like, well, why would anybody want what you don't want? This isn't even desirable for you. What makes you think somebody else wants it? And some do see the diamond in the rough. One man's trash is another man's treasure. I mean, I do get those philosophies, but that's rarely how you would want to describe a business transfer. So,
but you're not paying a premium for those houses, are you?
You're not.
You're paying, it's an opportunity. You're taking a risk and you're getting it at a bargain, and you go, well, I can renovate this or demolish it and start again. I'm buying the opportunity, and I'm not going to pay a whole lot for that.
Yeah, and that's where it gets boiled down to just the assets, what's on the balance sheet that's actually something that's physical. So, yeah, I'm loving this conversation because I feel that as accounting professionals, we have so much to contribute here. And if we choose to add to the suite of services that we're providing, this business advisory and coaching element, it does enable us to actually not only provide a quality service that really can help our clients, it really does give them a chance to really make an impact in the success of our clients. And then lastly, it's a great revenue producer for us. It's something that we can get paid very well for. And I really encourage that. So here's what I'd like to do. I'm going to kind of wrap this up and come back to you for a final thought. As part of the wrap up, I do want to begin with an offer. There's something here that I'd like to encourage everyone to take advantage of. In the episode description, you can go there and there's going to be information that you can take advantage of related to Capitalize Now. This is that system or program that Darryl was explaining. You can go there and actually receive a free demo of the software and see if this is something that you feel would be a great contribution to the services that you're offering in your firm. In addition to that, what I also want to point out is you can also in the episode description see some information there as to what you can do to become a profit and growth expert, where you can move into the CFO and advisory space and become for your clients a business coach. And in doing so, get a copy of 2 books that are essential for your success here. The first being Red to Black in 30 Days. It is the Small Business Accountant's Guide to Quick Turnarounds. It's something you definitely need in your library to refer to as you're dealing with the most common challenge that business owners face, which is cash flow. And then secondly is a book called In the Black, 9 Principles to Make Your Business Profitable. Obviously, one of the things that we indicated earlier is in order for a business to be of maximum worth or value, it does need to have that top line revenue and, more importantly, bottom line profit. And this is exactly the book that you need to read to understand what it is you should be doing to work on your business and, in fact, work with your clients. Now, with that being said, as a summary, I really enjoyed our conversation today. I think that, first of all, just looking at the who needs to be involved in this entire process is something that we need to consider. We were talking about those key individuals in the business, such as the business lawyer, the financial planner. But when you look at exit planning, it really gets down to the mindset of the business owner, what they're dealing with as they consider what is their exit strategy. And for some, they're in denial. Like Darryl said, some just think they're just going to work until they die. And I think that's just an ill-suited way of looking at the business. And there's something there that they're building that is of worth and an asset. And as accounting professionals, if we can just point that out in the simplest ways, whether it be the balance sheet, EBITDA, just start to educate the business owners as to what it is they really do in fact have and what they can be doing to work on the business. And then I really like the fact that we were able to identify that this is in fact something that we as accounting professionals can get involved in and do for our clients. It's something that they really are willing to pay for and can benefit from if we just took it to another level and really added this to the suite of services that we're providing. So with all that being said, Darryl, do you have a closing thought?
I think, look, the closing thought is, as accountants, it really is there for the taking. And my encouragement to you is you have the skill set, you have the relationship with the clients. Clients listen to their accountants. So this is a golden opportunity that plays to your strengths.
Beautiful, beautiful. All right. So for everyone listening, definitely go to universalaccounting.com and see there the free resources that are available to help you work with your clients to, in fact, help them build the businesses that they are deserving of. And in fact, see you as that CFO and advisor. There are a lot of free resources there that you can definitely take advantage of, and I encourage you to do so. Also, if you haven't yet subscribed to the podcast, do so. Subscribe, set your notifications to be notified of each and every week when we release a new episode. This is something that you do want to take advantage of as we each and every week bring on the experts, the various individuals that know what they're talking about as to how we can be working on our businesses and, in fact, building the premier accounting firm. So subscribe to the podcast, go back and also listen to the highlights that we have, the various episodes that you can binge and get the very important information you need to work on your business. The other is GrowCon. If you haven't yet, book your ticket now for GrowCon. It's an annual event. It's a conference for owners of accounting, bookkeeping, and tax businesses. It's this event that you don't want to miss, as you're going to hear from the stage experts as to what it is you need to be doing to work on your business, and also meet with your peers, individuals doing exactly like you, running, operating, and building the premier accounting firms in their areas. And likewise, you can also visit with our staff at Universal Accounting and interact with us here who are committed to help you be in business for yourself, but not by yourself. The other thing I do want to point out is regarding this and other principles. If you'd like to learn more about them, visit us at universalaccountingschool.com or give us a phone call. You can reach us at 801-265-3777. And always remember this, if it's about accounting, it is universal. Take care and be safe out there.